All right, good. Thank you, Collins. Thank you, Oluwatoba. Thank you, Manfred Adeogun. All right, so let's get started. So we have a sizable number of people. I believe others will join with time. So I want to welcome us to the second session of this boot camp. And today we have quite a lot to do. So I will want us to pay a lot of attention as we start. Now, first thing we want to do today is we want to look at Forex trading terminologies. And from there, we'll go to some practical session on MetaTrader. So I wanted to just make sure you pay a lot of attention to what we're doing this evening. All right, so let's get started. My name is Rotimi Olawale. I'm the trainer for PU Prime at the Lagos office. So PU Prime is a global brand. Global head office is in Australia, and we have two offices in Nigeria, Abuja and Lagos. The Abuja office is the head office for Nigeria, and the address is at 50 EP02 Ukiwe Street, Walk and Connect Building, number 50 EP2 Ukiwe Street, Jabi, Abuja. And the Lagos office is at number 54B Adeniyi Jones Avenue. That's Lagos Building, 54B Adeniyi Jones Avenue, Ikeja, Lagos. At these two offices will hold physical training events twice in a week, Tuesdays and Thursdays. But currently we are on a 6-week boot camp, session where we'll bring trading to you and, make it in such a way that will cover the curriculum in this same period of time. So there'll be two sessions. There'll be the online session, which you are in now. It is going to take place on Wednesdays, Fridays, and Sundays. So currently we're in the Wednesday session. The next session after this one will be on Friday, followed by Sunday. And you'll be communicated about the time and other details about those other events. All right, so we'll start. Now, we want to look at basic terminologies you need to know as a trader. And the first we want to look at is called the currency, base currency and quote currency. Now, when you have a currency pair quotation, when you pair a currency against the other, you want to buy one currency and sell the other, it comes in what's called a currency pair. Now, when you have a currency pair means you're merging two currencies together. For example, the one on the screen now is the Euro US dollar. And in this quotation, any currency on the left-hand side is called the base currency, and the one on the right-hand side is called the quote or counter currency. So this one that I'm circling in blue is the base currency, and this is called the quote or the counter currency. And it's it depends on the currency that's currency pair that's available. If this is a pound and Japanese yen, anything here will always be the base currency, and the one on the right hand side will be the quote or counter currency. The next is the bid price and the ask price. We say that the bid is the trader's selling price and the ask is the trader's buying price. But to make it easier for us, I like to use examples that you can easily relate with. If you have Naira and you want to buy dollar, and you meet the bureau de change guys that normally sell for us, or wherever you live, and you approach them and ask them, how much do you sell your dollar? And they tell you that, okay, my dollar is 1,600 Naira. Now that price may, I'm talking about the exchange rate now. That exchange rate may look a bit too high for you. So you may say, okay, you want to negotiate to probably 1,400 Naira. Now 1,400 Naira may look too low to the seller. So maybe eventually both of you negotiated with the seller and you both agree on 1,005. Don't forget the initial price you asked, he said 1,600. You negotiated to 1,400, but he didn't agree. Then finally, five. Now that initial price that you asked him, to sell the dollar to you, which is the exchange rate, is the ask price. And the negotiated price that is okay for both of you that you agreed on is called the bid price. So we say the bid price is the trader's selling price, and the ask price is the trader's buying price. Now, when you now find the difference, so usually the ask price is always higher than the bid price, because in the example we gave, the ask price is higher. That's the price you're trying to ask. You know, the bid price is always lower. If you look at this table by the right hand side, there you can see Euro USD, base currency, quote currency. Then you see the ask price 1.1527 and bid price 1.1524. So this is how you have a currency pair quotation with the ask price and the bid price. Again, the ask price is always higher than the bid price. Now, the difference between the ask price and the bid price is called the spread. I'll tell that again. The difference between the ask price and the bid price is called the spread. If you go back to this previous slide, you can see here the ask price is 1.1527, the bid price is 1.1524. If you subtract the last digit, you have 7 here and 4. 7 minus 4 is 3. That is the spread on that, you know, financial instrument. Now, every financial instrument, either it's currency, stock, indices, crypto, all of them have their individual spread, and that can go a long way even in you knowing which instrument to trade sometimes, because the spread will give you a lot information about the instrument. The next one to look at is a PEEP. What is a PEEP? Now, every industry have their terminologies they use in describing what they do. For us in the forex industry, we have the word PEEP. It's a word that you continue to hear as a trader. And it will come up every single day in your trading career. PEEP stands for price interest point. So instead of using the word point to represent the movement of price from a point A to point B, we represent it otherwise by PEEP or pips. So if price goes on by 10 pips, by 10 points, we'll say that's going to buy 10 pips. If it goes up by 100 points, we'll say that's going to buy 100 pips. So that's how we represent points in the forex market. And the next one I want us to look at is the lot size. Now, I want you to pay a lot of attention to this because this can go a long way in determining how long you stay, you know, in the market as a trader. Now, lot size simply determines the volume of trade you take as a trader. So we say lot size is what measures the percentage of your capital you use per trade, which in turn determines your profit or loss on that trade. Now, lot size can make your, if the lot size is high, your profit can be very big. And if it's on the other side, it can also make your risk to be equally very high. So it's something that you should use with a lot of caution. Uche is saying, what do you say a PEEP is? PEEP price interest point. You know, it's a representation of the movement of price from one point to another. I just responded to Kate Uche. Now, like I said, so there are 3 types of lot size. There is the standard lot size, the mini lot size, and the micro lot size. Now, I want us to focus on this table here, and I'll start from the first one. Or I think it's better, let me start from the third one, standard lot. Now, the standard lot is represented by 1.0, and it means for every 1 pip movement, 1 pip is represented by $10. That's this last section here. 1 pip is represented by $10, meaning if price moves up by 10 pips, that becomes 10 times $10 per pip, which is $100. For the mini lot is represented by 0.1, and 1 pip is equal to $1. Again, if price goes up by 10 pips, that is 10 times $1 per pip, which is equivalent to $10. And the micro lot is represented as 0.01. 1 pip here is 10 cents. So if price goes on by 10 pips, that is 10 times 0.1, and that gives you just $1. $1. That's 10 pips on a micro lot is $1. So what is the implication of this lot size? Like I said earlier, if you have a high lot size, a standard lot, for example, and you are able to trade like 50 pips, 50 times $10 per pip will give you $500. However, that's on the good side. If the market goes against you, you equally stand the risk of losing $500. So the profit can be high, but the risk is equally very high. For the mini lot size 0.1, you trade 50 pips. 50 pips times 0.1 lot. At 0.1 lot, it is 1 pip for $1. That's so 50 pips is $50. So with $50 on a good day, that's $50 profit, and on a bad day, that's $50 loss. Depending on your trading capital. Let's assume in all this you are trading it a $1,000 capital. A 50 people give you $500 profit on $1,000 account for one standard lot, but also you could lose $500. That means your account can get burnt faster. And if you're trading it on a mini lot, that's just $50 profit. And if it turns otherwise, that's $50 loss out of 1,000. So you still have 950. So your capital is still very strong. And if it's a micro lot, which is 0.01, that's just $5 profit or $5 loss. You still have a large chunk. So in essence, lot size should be used with a lot of caution. It can make your profit big, but it can also increase the risk on your account. So use minimal lot size at all time. It's one of the rules of risk management when trading Forex. Now, how do you trade? 3 things to also note when you want to trade. I believe this must have been mentioned in the previous class, but then let's talk about it. You need to note entry price, stop loss, and take profit. Entry price is a price at which you execute a trade, whether you want to buy or you want to sell. And stop loss is the risk you are willing to take on your trade. Now, we need to notice that in trading, we take a risk, in order to make a profit. Every time you enter a trade in the market, there is a risk involved. Now, there's nothing, the word risk is not much of a negative word, but it's just the reality of the market we trade in. And risk cuts across all businesses without excluding the Forex, business. Every business has a level of risk or the other. The higher the risk of businesses, actually, the higher the returns. And the lower the risk, the lower the returns. However, in Forex trading, you can limit your risk even before you enter into a trade. And one of the ways of limiting your risk in Forex trading is by applying this function on the trading platform called the stop loss. So when you apply the stop loss, it means you're already limiting the risk you want to take on a trade. So in other words, it means if the market goes against you, you are telling the platform that I'm willing to risk this amount in order to take a profit. So let's say you have an account of $1,000 and you professionally, you are not expected to risk more than 2% of your account per trade. So a 2% of 1,000 is just minus 20. So let's assume you say you put a stop loss of minus 20 on your account. That means that is the maximum risk you want to take on that account. You want to risk $20 in order to make $50 or $60, as the case may be. So stop loss is also another tool we use in implementing risk management when trading Forex. And thirdly, we have the entry price. The entry price, sorry, I've talked about entry price. I wanted to say the take profit. The take profit is a profit you're willing to take on a trade if the market goes your way. You don't want to be an Oliver Twist who just believes the market will just keep going, maybe in the buy direction, you feel it to just keep going buying forever. No, you have a particular price in mind where you want to take profit. So you enter a trade price, you've indicated, on the trading platform that you want a 50 pip profit and a 20 pip, stop loss. So once you indicate all this, which we are going to do tonight, and that's why I want you to hang on and just stay with us tonight, because I'll show you how to do all these things on the platform. I'll show you how to pick trade in this class tonight. So just exercise some patience as we gradually move to that section in this training. So in a buy trade, we expect price to go higher. We expect price to go from a lower value to a higher value in a buy trade, and in a sell trade, we expect price to fall from a higher value to a lower value. So in a buy trade, you expect price to go higher. In a sell trade, we expect price to drop from a high point to a lower point. Okay, Kate is saying stop loss is what? I said stop loss is a risk you are willing to take. Is a risk you are willing to take on your trade. That is what stop loss is a maximum risk you're willing to take. You're saying, in case the market does not go my way, I want maybe $5 or $10 on my account. If the platform can close it as a loss in order to protect my remaining capital. The essence of a stop loss is actually to protect your capital, because if you don't apply a stop loss, if the market goes against you by minus 20 and you refuse to close it, what if it gets to minus 100? When I'm saying -100 now, sometimes it could be like $100. I'm not sure if you calculate that in naira, that's a huge amount of naira. So it's sometimes it's a matter of being penny wise and pound foolish. So it's better to cut your losses early rather than allow the you cut your losses early and you allow the profit to run. Because in trading, like I said, risk is involved. There are times when things may not go as planned, and that is exactly why we're using what is called stop loss. It's like you having a car that doesn't have a brake system. that is a risk management tool in a car. Every car has got a brake. You won't say once you keep accelerating, there won't be any problem. No, something may happen along the way that requires you to just stop the vehicle. So just look at stop loss as the same thing as what the brake system is in a vehicle. I hope that is clear. All right, let's make progress. This class is being recorded and we'll share the link with you. After the class, you get the link to watch over again. So another tool, terminology you need to note, which is actually a tool on the platform, is the leverage. And we said that leverage is the ability to use a small amount to control a bigger amount. Now, the history, what led to leverage is this. Let me explain it to you. Now, trading has been on for several decades, before now. But then it was an international transaction between banks. And that's why Forex trading is actually an offshoot of the banking system. In Nigeria, there are banks, and our banks have a department called Treasury Department till today. Treasury Department in banks trade Forex. So Forex is a completely legal, legitimate business. There's nothing illegal about it. It's from the banking system. So, but back then, trading was done just between banks, and they used a large amount of money to trade in those days. $300,000, $500,000, $1 million. It was big, and at that period, trading was not accessible to retail traders like you and myself. But at the advent of the internet in the year 1999, 2000, brokers began to spring up, and they now devised this tool called leverage to make trading accessible to retail traders like you and myself. So when they applied the leverage, then that's when you can now see that brokers can say, okay, you can trade with $10,000, $50,000, $1,000, $500, $300, and so on. And it's leverage that has made this to be possible. So how does leverage make this to be possible? Now, you see here you have a leverage. Leverage is always in a ratio. Now, it can be a ratio 1 to 500 or 500 to 1. It's just a ratio. Don't bother about which figure is smaller or the bigger. It's just a ratio. Now, if you have a ratio of 1 to 500, like you can see on the screen right here, what it means is this. It means the platform is representing your trading capital as 1. So let's assume you put in a $1,000 capital, or equity on your account. Then the 500 is the factor by which the platform multiplies your trading capital. So you put in a trading capital or equity of $1,000, the platform now multiplies your 1,000 by 500, and that gives you like a trading capital of $500,000. So in essence, the platform is seeing your $1,000 as if it is a $500,000. But mind you, your balance is still 1,000, but the platform is seeing your 1,000 as if it's a $500,000. So what the platform is trying to do is to replicate the same type of capital that was being traded back in the days. And here we say that this means that for every $1 you deposit to trade with, Pacific Union is making $500 available for you to trade with. So it like boosts your account, for you to trade. And another benefit of that is that it also gives you opportunity to take on multiple trades. If you use a small leverage, like maybe 1 to 100 or 100 to 1, you may not be able to place more than one trade per time. But with the leverage of 1 to 500, you can take multiple trades by time. Though there's a word of caution, you don't need to put so many trades at a go, because it can also lead to what is called over trading. But then by and large, leverage allows us to trade a small account as if it's a big account for us to make profit in the Forex market. All right, two types of market in trading. There is a bull market and there is the bear market. The bull market is when price is trending up. That is a buy. It's a situation in which we buy. And the bear market is when price is trending down. That is a scenario where we're looking for opportunity to sell the market. Okay, so that's the end of this slide. We're going to end this slide now. Then we'll go over into MetaTrader. Now, at the end of the whole session, then you can ask questions. I don't want to interrupt the flow of switch over now, into the MetaTrader class. So please take note of your questions, put them in writing. At the right time, you can ask your questions. Come again about bull. I said bull is when the market is in the buy mode, is when you are buying. Bear is when the market is selling. All right, so we'll go over now to the screen for MetaTrader. All right, so the main session for today, we're actually to look at the MetaTrader on the desktop. The next class we'll do MetaTrader on the mobile device. So now in trading, the primary tool used in trading the Forex market is what is called the MetaTrader platform. The MetaTrader platform. Like I said earlier, at the advent of the internet in the year 1999, 2000, brokers began to spring up and they came up with, trading platform, and a company called MetaQuotes came up with, software developers who developed this trading platform called the MetaTrader platform. Meta, M-E-T-A, MetaTrader platform. Now, the first version of this MetaTrader is called MetaTrader 4, otherwise shortened as MT4. And there's now an upgrade on that MetaTrader 4, and that is MetaTrader 5. It's a higher version on the MetaTrader 4. Now, the difference between the MetaTrader 5 and 4 is this. The MetaTrader 5 contains more features compared to the MetaTrader 4. There are more indicators and additional functions on the MetaTrader 5 compared to the MetaTrader 4. But generally, the MetaTrader 4 is still an excellent, application that can be used. Sometimes we advise, beginner traders like yourself to just trade the MetaTrader 4. With time, you can advance, towards the MetaTrader 5. So this class, we're going to be using the MetaTrader 4 is the basic, for the MetaTrader platform for you to trade. And this MetaTrader platform is available for all devices. So you can always get it on any device you're using. Either you're using an Android device or an iPhone, or you're trading with a Microsoft laptop, or, Apple, Mac OS, or, anyone you want to talk about. The platform is available across board. Now, when you download the MetaTrader platform through your account, through your dashboard with PU Prime, and you open it, this is what you're going to see on your screen. It's going to open with this black interface. Now, this is what a Forex trading chart looks like. Now, we're going into important part of this training because you're going to be trading with this same chart. So I want you to pay a lot of attention at this section of this training that we're getting to. You need to pay a lot of attention and avoid every form of distraction. The link will be posted strictly in the WhatsApp group, sir. That's for Mr. Lawrence. All right. So now, when you download this platform, like I said, this is what you're going to see. You see a black interface. Now, sometimes this black interface can be confusing for people. I mean, it's with all the ash color background, it's not looking too, how do I really put it? It's not really looking too good for someone who doesn't have understanding of what is graph and all these charts, what it looks like. So the first thing we normally teach is how to format this chart to make it more visually appealing. Now, this is just visual appeal. It doesn't mean it will make you more money, but at least it will make it more interesting for you to look at, as you plan to trade. So the first thing we'll do, like I said, we'll format it, we'll clean it, and make it look cleaner than what we're seeing at the moment. So how do we do that? You right click on any part of the screen and you click on the grid button. You can see that button, grid, highlighted with blue on my screen now. And once you click it, you discover that all those boxes, those ash boxes, they've disappeared. So it looks cleaner. Now, you can take it a step further. If you're not a fan of a black background, the platform is flexible enough for you to change the background to any color of your choice. So what we're going to do now is that we're going to format the background and change the background from black to white. You can change to any color of your choice, but I prefer the white background as the next one to this black. So to change it to a white background, what we do again is you right click on any part of the screen and you come straight down to properties. You click on properties and this menu appears. Then you go to background, click on the background. Now we want to change the background color, which is what is on the screen now, from black to white. This is white menu. White, that's the last box there. You click on it. Now the foreground color is presently white. So we want to change that one to black. You can see the black box there. Then the bar up is lime. I want something richer than lime, a deeper green. So I'll click on green. Bar down is lime again, but I want something better. I will pick a red for that. Blue candle is black. I'll change that again to green. And the bear candle is white. I'll change that to red. And I'm done with my formatting. I'll click OK. And this is what we have. I believe if you've been familiar a little with trading, you see that there are a lot of traders you see that use this white background. It's more visually appealing, to use. Now, all these things you are seeing a green, red. They are called candles. Candles, like our normal Nigerian candles. Now, in the course of this training, we'll get to some point where we'll get to candlestick analysis, where we show you how to interpret each of these candles. Each of them have information encoded in them as you're seeing them, and understanding how to decode those candles can help you in making money in Forex. Merely looking at the candle, you can know whether the market is going to buy or going to sell. We will soon get there, but tonight is just introduction to the MetaTrader platform that we're doing. So these green candles are called the bull candles. Anytime you see the green, it means the market is buying. But when you see them more than the red, it means the market is buying. And when you see the red candles, they are called the bearish candles or the bear candles. It means the market is selling. Now, there are three types of charts that we want to look at. The first type of chart is this one here. If I come to the upper part of the screen, you can see, oh, sorry, that's not what I want to circle. You can see where I'm circling, this blue circle up there. I'll click it. So the first type of chart is called the line chart. You can see it's a little bit faint green. It's just a set of lines. You can see it now. I've made it, zoomed it out bigger. It's just a set of lines. Now, this line can be a bit difficult to interpret. It's difficult to interpret it, so we don't often use it. Now, the third type of chart is this last one here, which is called a bar chart. This one also can be a bit difficult to interpret, but the one we make use of most often is the one in the middle, which is called the candlesticks. You can see candlesticks highlighted there, and that is this particular one, which you have seen earlier. So we make use of the candlestick chart to trade the Forex market. So let's go a step further by looking at some tools on this platform. On the left-hand side here, you have what is called the market watch. The market watch, I'll just circle it. You can see it over there. That's the market watch. Now, it is on this menu we have all the financial instruments that can be traded, on the platform. All of them with the bid price and ask price. We've done the bid and ask the other time. And we said that the ask price is always higher than the bid price. And we said the difference between the ask price and the bid price is called the spread. Everything is available right on this at this section. And you can see the time on the market watch. Currently, it's 21 hours, 42 minutes. But our local time in Nigeria here is saying 7:42 p.m. So it means that the summer time of PU Prime is 2 hours ahead of our local time. So that means that a new day on PU Prime platform starts by 10 p.m. in the night, 10 p.m. Nigerian time. That is when the new day starts. So PU Prime will cross officially to tomorrow, Thursday, by 10 p.m. tonight, Nigerian time. So I want you to take note, of that. And now we want to look at how to place a trade. To place a trade, you come to this section called New Order. I just circled it now. You come to New Order. Now, I'll click on that New Order button. All right, this menu appears. And you have the symbol. The symbol is the currency or the financial instrument you want to trade. Now, I want to trade Euro USD. That is the chart that is opened on the screen at the moment. That is what the new order will bring out. If you open another currency pair, that is what you will see. So here we have the new order on Euro USD. Then you have the volume. Now, we just went through terminologies and I told you about the terminology called the lot size. And I said the lot size can help increase your trading volume. You know, it helps to determine the volume of your trade that is exposed per time. So on the trading platform, you are not going to see lot size. Lot size is represented as volume, either on the desktop or your mobile devices. You know, what you see is volume. If on the mobile device, it's not even labeled, but on laptop is labeled as volume. It's still the same thing as the lot size. And don't forget to always keep your lot size reasonably small. The essence is to protect your account. I'll emphasize again, big lot size means big loss, big profit. But if the market goes against you, it also means big loss. So trade with the reasonable lot size. If you want to use one standard lot is to be used on just on a $10,000 account. And if a 0.1 lot is to be used on a $1,000 account, and 0.01 lot can be used on any account less than $300. If you can stick with this, you will stay long in the forex market, which is what we want for you at PU Prime. All right, so we want to pick a trade now. There is the take profit and we have the stop loss. So before we take the trade, we want to set the take profit and we want to set the stop loss. So let's look to take a trade now. What do? We press this button. There's a scroll up button up there. And the current price of this instrument is 1.10128. Now we always ignore the last digit, the 5th decimal point. We always ignore it. We deal with just the 4th up to the 4th decimal point. So let's say we want to take a buy trade. A buy trade at a take profit of 50 pips and a stop loss of minus 20 pips. So we'll add 50 pips to the current price, and that gives us 1.1012 plus 0.0050. That gives us 1.1062. So what I'll do is also add a 62 right here, and I've set my take profit. Now for stop loss, like I said, in a buy trade is a minus. So we want to use a minus 20 as the stop loss here. So that will be 1.1013 minus 20, 0.0020. So that leaves us a 1.00993. That's our stop loss. So to take a buy trade, all we do is just click buy market button here, and the trade will be executed. So we go 1, 2, 3, I'll click buy, and that's the trade. So that is how to take a buy trade in forex trading. It's not difficult, it's just very simple and very straightforward. And if on the other hand we want to take a sell trade, you know, a buy trade means we expect the trade to go higher. We anticipate the value of the price to appreciate. Now, before we take the sell, I want to show something. All right, you can see the lines. You can see the green dotted lines. That's the entry price. This is the take profit, and this other red line is the stop loss. We said 50 pips for take profit, 20 pip for stop loss. That has been indicated, you know, here TP and SL. TP is take profit, SL is the stop loss. This is the entry price. Please, I want us to mute our devices so that we don't cause distraction. All right, on the other hand, if we want to take a stop loss, that will be the opposite direction. Sorry, if we want to take a sell trade, rather, that will be the opposite of a buy trade. So how do we take a sell trade? We'll click on new order again, and we'll come to this menu. Now, in a sell trade, now listen, and please, let's be clear on this. In a buy trade, price is expected to go higher. In a sell trade, price is expected to drop. All right. So with that in mind, to take a sell trade, we click on new order and we set take profit. Now, because in a sell trade, we expect the price to drop, we will be subtracting the take profit from the current price. In the buy trade, we said the take profit was 50 pips and we added it to the current price. But in the sell trade, we'll be subtracting that same 50 pips from the current price. So for a sell trade, we'll do 1.1013 minus 50 pips, 0.0050. And that leaves us a 1.00963. Now, the stop loss on the sell trade, because price is expected to drop, the stop loss will be a plus to the current price. So current price here is 1.1013 plus 20 pips, which is 0.0020. So that leaves us with 1.1033. So we click sell by market and the trade is equally taken. So this is how to set a buy trade and a sell trade in Forex trading. Don't worry, the link will be made available. You can watch. I would encourage you to watch this video over and over again. You know, this is what you need to set a trade in Forex. Now, I want to go to another important part in this class tonight, and that is the category of traders. Category of traders. Now, there are different categories of traders, and for us to do that part, you can see this section up here. There's M1, M5, M15, M30, H1, H4, D1, W1, MN. What does all this represent? It represents what is called time frame. Now, time frame is what determines how long your trade might stay in the market before, it closes, possibly in profit. Because you may be asking, if I place a trade now, how long will my trade? How long is it expected to run? Can my trade run within a few minutes or a few hours? All that is answered under the time frame. And this leads us into categories of traders. Now, let's do something. I'll click on M1. I've clicked on the M1 button. Okay, okay, good. Now, on the M1 button, if you come to this section, you can see the time is 49 seconds, 50, 51, 52, 53, 54, 55, 56, 57. Now, when it's 1 minute, a new candle will form. 59:00:01. We see a new candle now. A new candle is formed already. It's because it's night, volatility is a bit low. You can see here, you can see the red candle. A new candle is formed. So this means that every 1 minute, a new candle is formed in the market. What this candle represents is the forces of demand and supply that is moving price. So for 1 minute candle, every 1 minute, a new candle is formed. For a 5 minute candle, every 5 minutes, a new candle is formed. So this means that for many 5 minutes in time past tonight, this currency pair has been selling. That's what this means. This is a 5 minute time frame. Now, for 15-minute time frame, it means that every 15 minutes, a new candle is formed. So you can see this has been selling in the last couple of 15 minutes. Let's jump to 1 hour. Now, for 1 hour, it means that every 1 hour. Now, the next hour we have is 8 p.m. That means that 8 p.m., a new 1 hour candle will be formed in the market. Now, see from here upwards, price has been buying for a while on the 1 hour time frame, meaning that price has been appreciating in the market. For a 4 hour candle, this means that every 4 hours, a new candle is formed in the market. So for this 4-hour candle, there are 6 of it in a day. You know, we have a 24-hour day. So there are 6 4-hour candles in a day. There are 24 1-hour candles in a day. And this D1 is the daily time frame. This tells us what happens the entire day in the market. So we can see clearly that today, Wednesday, the 14th of August, the market bought throughout today. It was an opportunity to buy. If I've been buying, today is Wednesday, Tuesday, Monday. Market on Euro USD, which is a currency pair, has been buying in the last 3 days on the daily time frame. Meaning, if you got this information early and you placed a buy on Monday, between Monday and now, this instrument has gone as high as 130 pips. That will have given you 130 pips, depending on the lot size you're trading. If you're trading 0.01 lot, 130 pips is $13. $13 in the Nigerian exchange rate now should be close to around 17,000 naira thereabouts, because $10 is about 15,000. So 13 should be around 17, 18,000, which is no small money, at least with our current exchange rate. And if you're trading with a 0.1 lot, you know, with 0.1 lot, that means you're trading with like $1,000 and above. That is 130 pips, which is sorry, 130 pips is $130. $130 in the exchange rate today will be well over 170,000 naira just in the last 3 days. You know, that shows you the power of this trading business that we're showing you. Look at this. Sometime last week, thereabout, see how big for 2-day movement on the daily time frame. See the sell movement on the daily time frame for some days, you know, some weeks back. See how the candles moved here massively. If 3-day can give you 130, you know that all these ones actually produce much more than that. So these are the daily candles on the daily time frame. Then we have the weekly time frame. This one is a candle that shows you what happened to that currency the entire week, whether it was buying the whole week or selling the whole week. And you can clearly see how price has been buying on a long term, you know, from here down to the current place here, which is about 392 pips. How many weekly candles? 1, 2, 3, 4, 5, 6, 7, 8. That means in the last 2 months, because there are 8 weeks, 4 weeks in a month, 8 weeks in 2 months. In the last 2 months, this Euro USD has been massively buying to the tune of about 390 pips. Now, if you look at this other side here, it's been selling, it's sold here. That was actually earlier. Let me see the year. This was between the year 2023 July, you know, to like 2023 September. It sold to the tune of 826 pips. You know, it took some weeks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. About 3 months. You know, it dropped to the tune of 800 pips. So this tells you that the higher the time frame, the bigger the price movement you see. Now, finally, we have the monthly time frame. This one shows you what happened on the chart for a whole month. So one candle represents all the activity of the market in that whole month. So it's the biggest time frame we have on the MetaTrader platform for now. You know, there are some other platforms that have even higher time frame than this, but this is just good enough for you to get started. So how does this impact upon your trading, you know, as a Forex trader? I'll flip to a page now where we'll look at the implication of this. All right, good. So this takes us to what we call the category of traders. Now, in trading, all of us don't trade the same way because all of us have our individual personalities. Your personality may be different from mine, and that may go a long way in affecting how each of us trade in the Forex market. Now, like I said, there are four categories of traders, depending on the time frame each of them trade with. There is the scalpers, the day trader, the swing trader, and the position trader. Those are the 4 you can see they are heading right up here. Now, for a scalper, trading time frame, the scalpers trade on a very short term. They are short-term traders. They don't have the patience to stay too long in the market. They just want something sharp within, see, typical holding time, minutes. Scalpers hold their trade for just, you know, a few minutes. Trading signal, they trade many times during the course of the day. Sometimes the scalper can place 20 trades within a trading day or more. So they trade many times. They have many trading signals within the trading day. They typically hold their trade for just a few minutes. And the chart interval analysis, that is the time frame on the chart that they trade on the 1 minute, 5 minutes, and the 15-minute time frame. That is what scalpers trade on. Trade monitoring, they monitor their trade actively. In fact, scalpers are as good as what we can call full-time traders because they are always glued to their system, waiting for the next trade to take. The next category of traders are the day traders who do what is called day trading. From the word day trading means they trade within the course of the same trading day. They take their trade, they start it and end it within that same trading day. They don't carry over that trade to the next day. So trading time frame, same day. Trading signals, few. Now, while a scalper will take like 20 trades, thereabout in a day, day traders don't look for more than 3 to 5 trades within the same day. They don't do more than that within the same day. Typical holding time, they hold their trades for just a few hours, 1 hour, 2 hours, 5 hours, just, hours. Chart interval analysis, they look at the 15 minutes, 1 hour, 4 hour, and even sometimes the daily time frame. They use the higher time frames, that's daily and 4 hour, to analyze the market, and they use either the 15 minutes or the 1 hour to make entries. That's how they trade. Trade monitoring, they are active. They actively monitor their trade, but not as much as the scalpers. For scalpers, those ones, they are very active, while the traders are active. Now, the third is the swing trader who do swing trading. Now, swing trading is actually more of a medium-term type of trade. That's the trading time frame, meaning that their trade can run from a few days to a few weeks. That is the typical holding time. They can leave their trades, they can hold it to run from a few days to sometimes a few weeks. Trading signals, they have few signals daily for weekly. For a swing trader, sometimes they don't see more than like 3 signals in a whole week. They have fewer signals, but sometimes more accurate. We need to take note of that. And chart interval analysis, they look at the 1 hour, 4 hour daily, and even sometimes the weekly time frame. So the daily and the weekly time frame, they are used to determine the trend, while the 1 hour or the 4 hour is used to determine the entry. And trade monitoring, moderately active. Because their entry is based on 1 hour, or most of the time even 4 hours, they don't need to check their chart most of the time. They just check occasionally. And finally, we have the position traders. The position traders are long-term traders. Their trading signals, they look for a few trades monthly or yearly. They don't look for trade all the time, just once in a while, each other 1 month at a time, maybe 1 or 2 trades in a month. That's how they trade. And typical holding time, a position trader can leave their trade to run from a few months to a few years sometimes. And chart interval analysis, they look at the daily, weekly, and the monthly time frame. Weekly and monthly time frame is used to determine the trend, while the daily time frame often can be used to determine the entry. Trade monitoring, rarely active. Position trading doesn't require you being glued to your system. You only check it once in a while, once in a few weeks, once in a month, like that. That's how position traders, that's how they check their charts. Now, for scalpers always look for just small profit in the range of 5 to 10 pips, while the traders look for about 25 to 30 pips. Swing traders look for 50 to 100 pips profit, while position traders look for between 500 to 3,000 pips in profit. Now, it should be noted that position trading is actually for those that have a large capital. It requires a large capital and extreme patience. It's really required for position trading. So for you listening to me tonight, I believe you fall within the range of either a scalper, a day trader, or swing trader. Now, you need to be true to yourself as a trader to stick with the trading personality, with the category of trading that works with your personality. It can go a long way in making you a successful Forex trader. So I'm done with that. I go back to the screen. All right. So there are some indicators we use in trading. We have the moving average, we have the relative strength index. How do you get all these things? You come to this section under indicators. That's where we have our technical indicators. So we just want to attach a relative strength index. Relative strength index is an oscillator. You come to the oscillator section and you go to the relative strength index and you click OK, and it is attached to your chart. And how do you make use of this, indicator? Usually it has two sections or three. You have the 70 section, the 30 section, and the 50. For the 70 section, it's called the overbought section. It means when price is trending up, it gets so high to a point that it becomes overbought, meaning it will no longer buy, but rather it wants to reverse to look for an opportunity to sell. So at that point, your RSI will indicate that it's at 70. So at that overbought position, what you are looking for is a reversal in price from buying to selling. For example, price got to RSI about 70 here, and that is a candle you are seeing here, and you see the market, decided to sell. And at some other point here, it got to 30, and that's where you have price, and price reversed from selling to buying. So at RSI 70, price is expected to look for opportunity to sell, and at RSI 30, price is expected to look for opportunity to buy. Now, I want to sound a word of caution. Please don't misquote or misinterpret what I've said, because also I did not say that when RSI gets to 30, you should place a buy trade, and I never said when RSI gets to 70, you should place a sell trade. No, this is just as a guide. There are other confirmation tools you need to use to confirm your entry. But when RSI gets to 70, you can patiently wait now and expect a reversal. And when it gets to 30, you can patiently wait and expect a reversal into the buy direction. But never use RSI 70 as a point to place a sell trade, or at 30 to use as a buy trade. You need further confirmations before you can do that. All right, so that's going to be all for tonight. Other tools, you get to know them, along the way as we proceed in this course. Like we have the trend line tool. We'll do that maybe in the next class or the one after. We have the vertical line tool. We have the horizontal line tool. All the crosshair, you get to know how to use this in subsequent classes. Okay, so that will be all from me tonight. If you have a question, you can go ahead. You can type it in the comment section and I will attend to you. All right, so Omogo Dillon, what about those using Android? Yes, I said it, maybe you joined us a bit late. This class tonight is for MetaTrader on desktop. The next class will be for MetaTrader for mobile devices, Android, iOS. That will be done in the next class. So you have a laptop, this class is for you. You have a phone and a laptop, at least the laptop part is tonight. By the next class on Friday, we'll look at the mobile device, version of this particular class. We can't do all in one single class, there are different devices. Joseph, can you help us on one more indicator? Okay, the other indicator that I can show you is a simple one, and that is the moving average. The moving average indicator is a trend indicator. You click on moving average and you have it right here. And if I click OK, that's the moving average indicator right there. And the simple principle behind this indicator is that when price, now there's a constant word we use in forex trading, and that is price. And why do we use price? Because we are looking at exchange rates of currency pairs, and that's at the price, you understand? So if price crosses above the moving average, it indicates the market is in an uptrend. Now let me look at perfect scenarios to show you for this. So that is the moving average. So here, the price crossed from above to below the moving average, and you can see we have a selling opportunity. Again, it crossed from above to below, another opportunity to sell. Here, it crossed from below to above, an opportunity to buy. It dropped a little lower, but then crossed again from below to above, another opportunity to buy. Now, it should be noted that this instrument is very good, but not perfect, because you can see there are instances where price got above, but which is supposed to be a buy, but it reversed. Again, it got above and it reversed. So there is no perfect indicator in trading. We say that indicators are lagging. Lagging there means that many times price will have moved before the indicators react. So because of that, you cannot take a trade based on just one indicator. And that's why I said that don't place a sell because RSI is at 70 or it's a buy because RSI is at 30. You need to match at least minimum of 3 indicators together for you to know whether you want to buy or sell, a particular currency pair. Oluwatobione, what's your maximum loss recommendation on a $400 account? 0.01 is fine. Maximum 0.02. So that's for Oluwatobi. Please throw more light on relative trade sector. Now, I think I mentioned relative strength index, not relative trade sector. Relative strength index. What are the 3 best indicators to use? It's not about best. It's just about your strategy. It's more about your strategy. That all indicators, if you can match them together well, you can form a strategy. But then the ones that are easily, that are more used, the moving average, the RSI, and sometimes the MACD or stochastics, those, at least those 4, if you know how to make use of them, can go a long way in making you, at least if you're trading with indicators, that can give you an edge. Please, sir, can you help us on the record of the class? Yes, you will get the recording of this class. All right. Please, sir, on a $100 account, how many positions can someone open on 0.01? I don't advise you open more than 2, or worst case scenario 3. Don't do more than that with your $100 trading 0.01. Don't go beyond 3. And that goes also for even any lot size. Don't, by the time you are going beyond 3 open positions, you're already doing what is called over trading. Because, the way we trade, you don't want to have this false assumption that the market will always go your way all the time. There are times when, either we are wrong or there are some forces in the market that changes the direction. So if you just enter too many trades and the market moves against you, it may affect your capital. So trade with risk management consciousness at all time. Don't lose your guard as regards risk management. So I'll just scroll through to see other questions. What is the meaning of SI? I already explained that. Drop the link. No, the link is not going to be dropped here. It will be dropped in your WhatsApp group. Please, how to trade. We already done that. Don't worry, you can watch the video again. That's for Kate Uche. Can you help us on one more? I've added moving average. I've attended to some person asking about Android. Kate Uche, I'm actually lost here on how to trade. Please watch the video again. You'll get it. It's not so difficult. Okay, I think I've attended to virtually all the questions except the new ones. How do I download MetaTrader on my Android phone? That will be done in the next class. Is there a book you can recommend to beginners like us which can, that's why we're having this boot camp. So just join us every day. Don't worry, this is all you need to learn how to trade. Trust me, this is all you need. Just join us at this boot camp. You'll learn all you need to learn. I need to be added to the WhatsApp group. Yeah, which WhatsApp group again? I believe you got the link to this class through a WhatsApp group. Johnson Oludari. If any WhatsApp group you got this link, that's your WhatsApp group. Don't worry, we'll send the link there. We have multiple WhatsApp groups, so whichever one you find yourself is where we'll reach. We'll get across to you. How do I get PU Prime MT4 on Mac? You need to log in. If you want to download it on Mac, you need to log into your dashboard. Go to puprime.com and sign in. If you have an account with us, you sign in. You go to the download section. From there, you can download the PU Prime, the PU Prime MetaTrader platform from there. Johnson, I'm not in the WhatsApp group. I'm not in. So how did you get the link here? Is it through your mail? So let me know how you got into this class. Did you get it through your mail or how did you get into this class? Someone called you. Okay, did the person send you the link to this Zoom? Okay, so reach out to that person. Is that person the staff of PU Prime? If the person is the staff of PU Prime, then reach out to that person to add you to the WhatsApp group. All right, I want to quickly do something. Somebody's asking me how to download the MetaTrader platform. So I'm flipping over now to Google. From there, we'll sign in to my account on the PU Prime platform, and I will show you how to download the MetaTrader. But then I think this will still be done in your next class. But let me just oblige that person. So you go to puprime.com, click on login. I'll sign in with my account. All right, so this is my account with PU Prime. Then I'll go to the download section. You can see here, live account, demo, funds, promotion, then you come to download. Click on download. Under the download, you can start trader. So it's either 4 or 5, but I want to select MetaTrader 4. So I'll click MetaTrader 4. Then you can see here we have for all the platform. If you're using a Windows device, click download for Windows. If you're using Mac OS, click download. If you're using a Linux server, click Linux. Now, if you're using an iPhone or iPad, click that. But then this iPhone, iPad, and Android, I would rather prefer you do it directly from your, from your device, your mobile device. I think that's a lot better. But for the desktop devices, you can click. If you are using Windows laptop, click on it. Mac OS, click download. Linux, click download, and that's it. So I've answered the person that is asking me how to get PU Prime on Mac. So if you are using a Mac device, just click download for Mac OS, then you download the trading platform from there. Okay, so I've attended to that question. Any other question as we round up? So don't forget that this training continues on Friday. We'll notify you about the time, but it could really be around the same time. And also we have the online class again on Sunday. We have the online class on Sunday. You can just join us. On Saturday, we'll have physical class in our 2 offices in Lagos and Abuja. So if that is suitable for you, you can also attend that. All right. Okay, so I think with that, we've come to the end of today's training. If you're yet to have an account with PU Prime, I will encourage you to just go straight to that our website right now and click on www.puprime.com. I'm typing that in the comment section, puprime.com, and open a live trading account. Your account manager will reach out to you immediately. You do that, and they'll guide you through the entire registration process. Okay, Johnson Oludare, you're asking me to hold on. So what do you want to tell me? Go ahead, sir. Omogo, you don't have office in PH, not at the moment, but we're planning on, increasing our coverage across Nigeria. But if you're in PH, you can start by becoming a partner with PU Prime, by being our representative over there. And with time, we might look at coming around. But then we have planned to get into more cities across Nigeria. So, Mr. Johnson, what's your question, sir? Okay. Well, I will advise you reach out directly to your account manager on that. So just discuss with your account manager on that. You're welcome, sir. So we have market analysis sessions every day, Monday to Friday, 7 a.m. in the morning and 12:30 p.m. in the afternoon. During these analysis sessions, we show you the direction the market is going to go for that session and the specific instruments that will likely be moving for you to trade and make profit. So tomorrow, 7 a.m., there will be morning market analysis. Make sure you don't miss it. The link will be dropped in your WhatsApp group. Just click on it and join us and know the direction the market, will be going for tomorrow morning by 12:30 p.m. again tomorrow. And other days we'll have the afternoon market analysis session. Physical training will hold in both our Lagos and Abuja offices tomorrow. So if you live around Abuja and its environ, I will encourage you to visit our Abuja office at Work and Connect building, 50 B2 Okiwe Street, Jabi, Abuja. And if you live around Lagos and its environ, you can join us for our physical class tomorrow at the Lagos office at number 54B Adeni Jones Avenue, Ikeja, Agos Building, 54B Adeni Jones Avenue, Ikeja. The time for the training tomorrow at Abuja, the physical training, is 10:30 a.m. and the time for the Lagos is 11 a.m. So we hope to see you at these trainings tomorrow. Please, after this boot camp, do I still need the PU Prime robot trading? It depends on you. It's your choice. Even during the course of the training, this boot camp, you are able to perfect, your manual trading. Then you can go ahead and trade manually. But at the same time, also you can actually, how do we manage your risk? You can leave your account for the robot trading, while you have a second account from which you can trade manually. You can do both. You can explore an array of opportunities in the market. So that's just my advice on that. Is there anything like Sense account? Yes, we have a Sense account. You can apply for that. You can talk to your account manager. He or she will guide you through on how to access your Sense account if that's what you want. All right, so that will be all tonight. Thanks for being a part of this class. Hope to see you again on Friday for the next session of this bootcamp training. Take care and have a wonderful night rest. Bye-bye.